This is the 401k Fridays podcast, and I'm your host, Rick Unser. Now here we go with this week's episode. If you couldn't tell, the COVID pandemic and its impact on the economy, retirement plans, and individuals has really got me thinking this year. Along those lines, a recent presentation from this week's return guest, David Blanchett, the head of retirement research for Morningstar's investment management group, on total economic worth, also struck a chord. This is a very interesting concept that I felt was pretty broadly applicable to retirement plans to help communicate the importance of saving today and how that translates to resources to fund your future lifestyle in retirement. We cover that and much more in a fast-paced and entertaining episode. Now, if you listen to your podcasts on 1.5 or 2 times the normal pace, you might not want to do that for this one. Also, if you didn't know you can listen to your podcasts at a faster pace, well, you're welcome, and now you can consume more episodes in a shorter period of time. If you like what you hear from our guests on the podcast, be sure to look them up on LinkedIn or other social media sites. Let them know you enjoyed listening to them on the 401k Fridays podcast and engage with what they put out in the world. That always helps great repeat guests like David have an easy decision on whether to join me again in the future. That's it. I hope you enjoy my conversation with David. Well, David, thanks for coming back to the podcast. It's always fun when people rejoin me. It's I don't know, maybe a good thing, but I appreciate you being here, and we've got a lot to talk about today, so I'm looking forward to jumping in.
Good to be back. Thanks for having me.
So you said something that really caught my ear, and it so resonates with something that I think is important, which is just the kind of myopic or the singular focus on what is my 401k balance, as whether it's at a plan sponsor level. Hey, our employees are doing well, average account balances are going up, our total plan balances is an all-time high. When people kind of get focused on that, or that's really their yardstick for how well they're doing in retirement, what does that make you feel, or how do you think about that?
Sure. So, I mean, I could have a T-shirt that says "I love 401ks." I don't want to, I'm not trying to be negative here, but if you think about assets and wealth more holistically, the 401k is just one small part of it, right? The largest asset of most households is human capital. We can define that later. The largest financial asset is their house. Usually you have assets outside of the 401k plan. So 401ks are important, but there's just so much more that matters for someone's, ability to accomplish a goal, how they should invest, everything else. So 401ks are very important, but by no means is it everything that you should be focused on as a plan sponsor, as a participant, as an advisor, consultant, etc.
And I want to pull on that human capital string for a second, because I know we can go super deep and super technical on that real fast, but I don't think that's something that a lot of employers or even individuals think about. And I don't know, like if I look back on 2020 and it's like, what did 2020 teach us as it relates to retirement plans and savings and, wealth building? And I'll let you define this better, but the human capital side of this, your ability to generate income now can be disrupted and can really throw a wrench into things, whether it's just a simple reduction in income. Hey, my hours were cut, or hey, I'm a salesperson and I'm not able to sell as much because I can't travel, or my customers are, hurting. Little things like that, all the way up to I lost my job and I don't know when I'm going to be able to work again. I mean, that I think can't be underestimated, especially after what we've lived through in 2020.
Right. So, I mean, I think, we should define terms, human capital, just think of it as the present value or net present value of all your future wages. Okay. So what does that mean? It means that you are your largest asset, right? Each person, you can go out and you can make money every year, and you do that for 30 or 40 years. That's worth millions of dollars, or whatever it is based upon what you do. Okay. And people don't realize that, right? We think of assets, we always focus on, well, how much do I have in my 401k? What is my checking account balance? Well, no, like you are an asset, you as an individual. And so your ability to make money and to stay productive and to work, those are things that are important, not just for your well-being, but also for you kind of financially.
Yeah, and that makes a ton of sense. And when I heard you say that the other day, it really, honestly, it just kind of put a different spin on how I've been looking at my own situation and the way that I'm making decisions. And I guess if you kind of keep going down that path, if somebody's light bulb just went off and said, "Wow, that's a different way to think about saving or dollars." How do you kind of help employers, or how do you help employees maybe start to connect the dots on, what this means for them, and how do you maybe do something different to get a better outcome down the road?
Yeah, so it's funny, the idea of human capital, it's not my idea, right? It's been around for decades, and we use it at Morningstar to help participants, help plan sponsors determine, for example, what is the appropriate risk in your portfolio. We used to call it our human capital methodology. It's actually patented as such. And, but I actually changed that. It's now we refer to it as our total wealth methodology. And that's really important because really what human capital is, it's one of the assets that everyone has that collectively makes up your total wealth. And so, what is your total wealth? Well, your total wealth includes your financial capital, like your 401k. It includes your human capital, which could be things like you can go out and work and make money. It includes pensions. You're going to get Social Security, possibly private annuity. It includes the value of your home. And I think that the key for this and for all this is to kind of to ask these questions, right? Is to understand, well, I have all these assets, and I might have liabilities too. How do I think about all these to make the best choices for me, again, financially and everything else, to ensure that, I'm not forgetting something when it comes to it, investing portfolios, offering benefits, things like that.
And if I'm hearing this as an employer, and I wanted to try to communicate this, is this a, hey, I need to talk to my record keeper, I need to talk to my advisor, or is this something that now we're going into like jujitsu territory, and I probably need to to work with a third party, or I need to to think about doing things really differently in my retirement plan?
Well, so I think that there's some somewhat straightforward implications or takeaways, right? So, human capital is a term that gets thrown around in a variety of domains, but offering wellness solutions is a way to potentially help your employees maintain their human capital. It reduces their financial stress. When we think about it for companies, it's often in terms of like developing a custom glide path. So, for example, if you work in the mining industry, you have a riskier human capital. You should, in theory, have a more conservative glide path when it comes to your 401k plan. If you have a pension, your participants have a very relatively bond-like human capital. That should also affect your glide path. And so I think that there's somewhat easy implications from a plan sponsor perspective. It's obviously a lot more complicated for the individual employees because everyone's so different. But, if you work for an employer, there are going to be some kind of collective overlaps that you should think about when it comes to, what am I doing for my default investment? What is wellness? Things like that.
Got it. So that all makes sense on the investment side, but what about on the saving side? We hear a lot about the looming retirement crisis. We hear a lot about, people are going to be eating cat food and, not able to support themselves, and they're going to have to rely on the government and, all these other things that I'm sure people see in the headlines. But I know you do a ton of research and you've got a ton of numbers at your fingertips. What do those say, and what are you seeing?
Yeah, so it's, like the news is the news, right? Like it wouldn't be the news if the headline today was "Stay invested in your target date funds," or "Keep saving for retirement."
Everything's
fine.
They
gotta think, yeah, everything's great. Just go back to work and hug your kids and everything else. No, they gotta, crisis. And so, I think, the funny thing about cat food is if we didn't have Social Security, cat food would be like a very real thing. We have an incredibly generous public pension system in the U.S. And so, I kind of take issue when someone says we have a retirement crisis, because we don't. A crisis means that people, when they retire, they're like destitute and they can't do anything. Now, I think we have a retirement savings crisis in that, people aren't saving enough to maintain their same lifestyle when they retire, but they're not going to be living off cat food, right? Like they're going to have some minimum, standard of living they can get by on. So, but I do think, to your point, that savings are really important, and that it's really important for, plan sponsors to help participants save for retirement. We've been, talking about human capital. Human capital is an asset. It's your largest asset when you're, say, 25 years old. Let's be honest. That asset gets depleted over time. Maybe the value increases because you acquire new skills, but your options for work aren't going to be all that fantastic when you're 80 years old. Right? It never really goes to zero. You can always be that guy at Walmart saying hello when you walk in, but that's not a very good job that most people want to worry about. And so I think that the key is helping people understand that they have human capital and they have to save some of it to kind of ensure that when it goes away, they can keep doing fun stuff. And so I think that it all kind of ties together, right? Again, I think we have a retirement savings crisis, and it's related to how much of people's human capital they choose to fund their future consumption.
Yeah, and I think that's an interesting point there. And I literally just got off a call talking about choose versus, not choose via, automatic enrollment and other tools. I feel like the technology, I feel like the behavioral economics conversation has really advanced over the years. We haven't talked about automatic enrollment on the podcast in a while or some of these other concepts, but I guess what are you seeing in that? In that whole conversation, or what do the numbers say around, okay, well, choice versus plan design defaults? Does the research hold up that you look at, or what's your kind of input on what helps people get farther down the road or get to a better retirement outcome?
Yeah, so I've done a bunch of research on that topic. I'm actually working on something right now that kind of combines automatic enrollment, match rates, and match levels. But I think that the research on this is somewhat unequivocal. Automatic enrollment leads to higher participation, but a huge problem that I have is it's led to lower savings rates. And anyone that back in 2000 there was research that talked about if you do automatic enrollment, it doesn't matter if it's 6% or it's 3%, doesn't affect participation. But so many plan sponsors chose 3%, and so to me, things like automatic enrollment, which actually still isn't as popular as you and I might think it is, hasn't necessarily helped a lot of people have a better outcome because they're saving 3 or 4 or 5%. I think that, if plan sponsors want to get serious about helping people save more for retirement, it needs to happen through automatic enrollment and pretty aggressive default savings targets. We're talking like 8% plus, because here's the thing. If you do it at 3%, participants are going to say, that I can do that and I'm done. And that's not actually helping us get to a better place. It actually leads to a worse place. So I know that 6% is the default, is overtaking 3% slowly, but the damage has kind of already been done. And I think it's incumbent upon all of us to kind of help plan sponsors reevaluate that decision and move to a better one.
So I'm with you, and I've seen probably some of the same studies you've seen, but for the average plan sponsor, the idea of saying I'm going to automatically withhold 8% of someone's income in my workforce, that gives a lot of people heart palpitations when they start really thinking about, oh my gosh, I'm sure for some people this is going to be great, but what about for Jim, or what about for Sally, or what about for this, this segment of our workforce where they are hourly, or they're whatever the case is. So, you're sitting in the room with that individual, or they're listening to you right now. What do you say to them, or how do you help explain or craft a message around, I understand, but here's the way this works in reality?
Yeah, it's the same reason that Costco has all those expensive TVs when you walk in the store. I go to Costco every week, and they have TVs that cost like $4,000. And who's going to spend $4,000 on a TV when you can get a TV for like $300? I think that why I like the idea of an 8% is it's an aggressive target, and I totally agree that most people can't get there. But here's what I want to have happen: I want someone to see 8 and say, I can't do 8, I'm going to do 5, and work to 8. I don't want someone to see 3 and say 3. That's awesome. I'm doing what they want me to, and I'm done. And so, I mean, and the thing is, you can always say no. We don't force you in the U.S. to save for retirement, at least in most plan schemes. And so, I think to me, it's a more realistic target. And I totally get it that a lot of folks can't do that. They've got too much else going on. And a lot of folks probably shouldn't. I mean, if you've got, credit card debt, other things, it doesn't make any sense for you. But I want more realistic targets, what it's going to take to help people retire successfully. I mean, I think about my parents. They were both public school teachers. They were able to work for 27 years, and they have a fantastic retirement because they were forced to save. right? They didn't see it. And so obviously, it isn't like that inside defined contribution plans where you have to make the affirmative election to save for retirement. But there is something to be said where if you don't have to make the decision and it's automatic, then it's probably easier, and it's going to help you, I think, over the long term, have more money saved for retirement.
The other thing that I've seen is a big trend, and I think we talked about this one of the last times you were on the podcast, was there's so much more data that's at our fingertips these days, whether it's a record keeper, whether it's an advisor, whatever it might be. What are you seeing people do with that data to kind of help create better outcomes, or how can an employer say, all right, well, I got it. We're doing the basics. We're checking a lot of the boxes in terms of plan design and communications, but what's the next step? And is that next step really leveraging data in different ways?
So it kind of is. I mean, I think that data can be powerful if used correctly. I think, like what we've seen a growth, for example, in kind of replacement rate studies. I think that more plan sponsors want to know how their participants are doing. Well, I think that like the motivation there is really good. A problem, right, is that you only have a pretty small window into someone's retirement future. If they've been at your company for 2 years, and they're 50 years old, you have no idea what they did for the previous 20 or 30 years, what they might do in the future. And so I think that I think it is important to understand how your participants are doing. But, I would really focus a lot on deferral rates and looking at metrics that look at how much wealth participants are accumulating while they're at your company. So they've been there for 3 or 5 years. Over that time period, what percent of their income have they been able to save on an annualized basis? I worry that a lot of the replacement rate studies that kind of try to do that full-on retirement projection are kind of overly gloom and doom for older participants because, if you join when you're 50 years old, you don't roll your balance in, things look pretty bad. That may not be the case. And so again, I think the data can help you make better decisions. It can help you figure out who you should target, who you should talk to. But just be aware that within 401ks especially, you don't have full information on participants, and so don't kind of extrapolate necessarily how the plan is doing with exactly how all the participants are going to do it when they eventually retire.
Yeah, and one thing that I think is also tough for employers to really, let's call it, get their arms around or understand is just, what else is going on in someone's financial life. And I think whether it's student loans, whether it's credit card debt, whether it's trying to buy a house, whether it's having a kid, how are you seeing some employers try to help or assist people in that, or at least kind of get their arms around what is going on in their population so that as they think about whether it's retirement plan or financial wellness or whatever changes they might want to make, how do they do that so it's a little more supportive, a little more targeted and applicable to their populations?
Yeah, it's funny. I mean, me personally, I don't know that I would love the idea of my employer knowing all these things about me, right? So I think the key is making available the resources and the tools and services the participants can use easily should they want to do so, right? I mean, it's hard to seek out things, but if my employer has, a group that I can call that's very easy, that reduces the barrier for me actually seeking that out. So I think the more tools and services that employers give participants, the better off they're going to be.
And we've heard a lot about student debt. And I think you wrote something recently on, some things you learned from student debt. Is that really as big of an impediment to retirement savings as some in the market would say, or are there things that people can learn from, student debt and kind of managing through that process that maybe set them up for success in the future?
Yeah, I mean, I think what's really important to note is that I still have student loans. My wife has student loans, but for most people that have them, it's because they have jobs that pay relatively well. And so it's not necessarily consuming, all their resources. Now it is consuming some of them, right? There are people that have gone to school that could not get employment that have, high debt. But I think it's another possible impediment to saving for retirement. Other impediments are things like buying a home, having kids. It's a financial drain of your resources. And so, I know that there's been some companies that have rolled out, programs and platforms for student debt repayment, right? And I think that that's good because, let's be honest, if you hate having student loans and I hate having student loans, maybe you're going to be willing to kind of put more money aside to pay those things off, and you can turn into a good saver than if you didn't have them. So I think it is an issue. I think that hopefully individuals that learn to repay the loans are creating better financial habits, but it really varies, I think, based upon each person's situation.
And that kind of brings me to another thought where I think the world is obviously evolving, things are getting more complex, but at the same point in time, I feel like for the average individual, and let's just say the average individual is someone who has, not a lot of money saved outside of their 401k plan. The path to them to get help, support, guidance is probably more challenging than ever, as we're seeing a lot of fee compression in the retirement industry. A lot of people who maybe used to be able to take on a client that had $50,000 or $100,000, now they're saying, hey, well, even for me to sit down with you, you need to have $250,000. You need to have $500,000. I know there's obviously some financial advisors out there with, minimum investment thresholds in the millions of dollars. But anywho, that's also been one thing that I think from an employer standpoint is just an important understanding, is that a lot of times the only way that they're getting information or they're a more consistent source of financial information, trusted financial information, will oftentimes come from the employer, because there's just not really many other places for people to turn. Am I overdoing that, or is that somewhat of a realistic statement?
I think you are spot on, right? The employer for the 401k is a fiduciary. Yes, you can be a fiduciary in the retail or consumer space, but let's be honest, a lot of people aren't. And I think that gets to my earlier comment, where the more things an employer can do to ease that process, the more likely someone is to seek out the information and at the same time get good advice. I think you raise a really valid point about, advisors outside of DC plans. I'm a little biased. I'm a fan of robo solutions. I think that, someone that does want help without a ton of assets, they can be a great avenue, because usually they're going to be a fiduciary. Usually there's going to be relatively low fees, and they can do a pretty good job. Now, in theory, as your situation gets more complex, you can you can seek out that advisor, but, for a lot of folks, it's actually pretty simple when you're young. You want to save as much as you can. You want to save to buy a house and stuff like that. But I think that, again, the more that employers can do, and a lot of them might say, well, it's not my job to do this stuff. Well, but here's the thing. If you've got 5,000 employees, for example, you can help so many of those people so much faster than if they all had to, kind of seek out these services on their own.
Yeah. And I think that hits to just kind of the evolving role that an employer has, the evolving role that their service partners have. And, what do you see going on there in terms of, where do we go from here? It already feels like employers are being asked to do more. Their service partners are being asked to do more and get more involved in the financial lives of employees. And really, I think, I've been doing this for a little over 20 years, more than any time I can remember. So, does this trend keep going, or like where does this take us in the future?
Yeah, I think that, I'm sure you've seen this. Some employers aren't going to do it. Like, they're going to say, like, it's my job to make widgets. I make widgets. They can figure this on their own. But I guess I see parallels into just the world of financial advice, right? If you go back, I remember when I first started this industry, like, everyone called me a stockbroker. I was like, I don't sell stocks. I give financial advice, but even today, there's a pivot away from, you don't just build portfolios. You help someone accomplish financial goals. I think that there's just a realization that employers have the ability, if they choose to do so, to make a really meaningful impact on their employees' lives through a variety of services. And you don't have to offer these things, but I think you can see this in the media, like this is a tool to retain and attract new employees. These are things that people value that aren't necessarily very expensive, especially if you've got the scale of a large employer. So, I wouldn't say you have to do it. And a lot of the benefits of these things are often hard to quantify and things like that. But people need help. Everyone needs help at some point. And the easier it is for them to find good help, the better off they're going to be.
No, that makes sense. So David, we've moved around the horn here pretty quickly and pretty efficiently. So I appreciate all your insight. I guess let me take you back to where we started. So, everything that we've just kind of talked about, kind of coming back to that concept of human capital. What can employers take away from that? How can they maybe help more light bulbs go off in terms of kind of realizing the unique times that we're in today, and also kind of getting people to maybe think differently about this asset that they have, which is themselves, and how they sort of use that and maybe save that asset for use down the road?
Yeah, I mean, again, I think that the way that an employer would go about it depends upon, and this gets to earlier conversation about how engaged they want to be. I mean, you don't necessarily want to poke this bear if you're not going to offer any services or solutions, but to the extent that you're interested in helping someone understand what they should be doing, there's lots of avenues that you can go down. It's offering services about, managed accounts, saving for retirement. It's offering services about financial wellness. It's doing the things to help people understand the value of their human capital, right? It's doing things as a plan sponsor to understand, how it affects the services that you're offering, how it affects your portfolio. I mean, there's a lot of paths you can go down when it comes to things like total wealth and everything else. But I mean, and I think that we're doing things as an industry right now. Like I know there's a lot of disagreement about like the lifetime income projections on statements. I think that's really important, right? Because I mean, like a 401k balance, like what does that even mean? Like I've got $45,000 saved for retirement. Like, who cares? I think that, things like that, where you're kind of repositioning the asset into income, and you're reframing what they've done to what it means for them, that's going to help, I think, drive better outcomes.
Yeah, and I think the interesting thing, just obviously with some of the changes in regulations with the Secure Act that came out back in 2019, I think a lot of people have kind of thought that, okay, now this whole income conversation in retirement plans is really going to come front and center. Obviously, last year we got a little derailed with COVID, but hopefully 2021 comes up. But I got to tell you, the interesting thing, just the ironic thing here, as all of this is maybe building some momentum behind the scenes, we've got interest rates at all-time lows. So when you look at some of these numbers, it may, that picture is maybe a little bleak just based on, where we sit today with, whether it's, 5-year, 10-year, whatever on the treasury yield that is, at absolute historic lows.
Yeah, I'm a skeptic now when it comes to guaranteed income. I'm a huge fan of how it can work. I guess I should caveat that better. What worries me is that people, to your point, had said, with Secure, there's going to be a rush on annuities for DC plans. Well, I've always said, like, I think for most people, there's like 8 hurdles. This removed one of them. Even for those that had one hurdle left, they're gonna create a new one to kind of prevent them from pulling the trigger. I think that more plan sponsors are thinking about it and talking about it. But to your point, now that rates are where they are, annuity sales were plummeted, especially those focused on traditional guaranteed income at the end of 2020. Now, with the irony though behind that is that when interest rates are low, guaranteed income actually makes the most sense because you get the benefit of mortality pooling. That's a complex thing, but it still matters. But again, like this is an example of someone's total wealth. It's saying, hey, how do I replace my human capital when I retire? Well, historically, we had defined benefit plans, right? And that was an automatic way for someone to move from working to retirement without worry. You will worry if you have a 401k. It can always go to zero. You can always live a long time. The markets can crash and bad things can happen. If you offer guaranteed income and you offer a high quality product, you're removing a huge pain point, which is that, let's just call a spade a spade. Not all annuities are very good. There's some expensive products that have high surrender penalties and all this out there. But 2, you're simplifying the process for someone to actually move into the product. And so, I'm hopeful that we'll see more advancement in the space, whether they make them available inside of a plan or attach annuities to a default investment. Again, I think like that's the kind of question you're asking. Hey, how do I help move someone to and through retirement versus just say, helping them accumulate a balance when they retire and wishing them well when they do eventually retire.
Yeah, and this is just a sample size of one, but a recent rollout that we helped with. There was we took a survey on the front end of this just to make sure from a financial wellness standpoint we were heading down the right path. And we were shocked, the client was shocked that 63% of respondents said creating retirement income was one of their top three concerns. And it was one of those, okay, we were expecting student debt, we were expecting credit cards, we were expecting, something other than creating retirement income. And I think that, to your point, I think one of the biggest anxieties a lot of people have is outliving their money, not having, how do I take this and do this and create income out of my savings efficiently and effectively? So I think it's something that we can't underestimate.
Yeah, I mean, it's funny. There's been a lot of surveys that show people are more afraid of outliving their money than dying, right? That's not how it should be. Retirement should be, in theory, if a time of leisure. But I mean, think about it. If you just retired in February of 2020. Right. And then you've got a 30 to 40% market correction in March. And you're like, well, what am I going to do? And so I think, I understand that a lot of employers don't want to help someone get through retirement. They see it as their job to help someone save enough and retire. But, large employers have tremendous ability to get incredibly high quality products that people will not get in the retail space. When you move from a group of 5,000 or 1,000 or even 500 employees to an individual of one, your options change significantly. And so, I mean, again, I understand the concerns that some employers have about offering guaranteed income and creating products. But again, I would just say that, if you're up for it, you can really create better outcomes because you can get great pricing, great products, and great adoption.
One other element in human capital that you mentioned a couple times was someone's house, primary residence, whatever it might be. And I think, I'm in California. There's certainly been a ton of appreciation, a ton of growth in the value of people's homes. So I don't know, like when you look at that, is that a good? Well, I can't imagine it's a bad thing. But are there concerns? Are there things that employers or tools or resources out there in the marketplace that can really help people kind of think about? Okay, well, what does this mean to me that I have $300,000 in equity in my house or $1 million of equity in my house that is developed over the last several years? And hey, I'm in great shape for retirement. I've got a 401k and I've got equity in my house.
Yeah, so houses are like the most fascinating asset that I have studied. And the reason is because they are both a consumption good and an investment good. And I'm going to define that. So they're a consumption good because you have to live somewhere, right? I guess you can move home with mom and dad, but if that's not an option, you're going to have to rent a place or buy a place. Right. So you have to live somewhere. But at the same time, to your point, they can be phenomenal investments. Right. And that can be as just in gigantic air quotes. Right. Because, people thought that you couldn't lose in homes, I think, pre-2008. Right. So, if you are fortunate, if you do live in California, then you might have significant equity that you have in a home that you can use to help fund your retirement. Congratulations. The problem with homes, though, is there's significant idiosyncratic risk. Right. So, and what that means is that, the experience of folks in Detroit or Phoenix has not mirrored the experience as it has in California. And well, I mean, for those nerds out there listening, like this is important because when you're thinking about the risks of a home, you just can't use like the Case-Shiller National Home Price Index. The Case-Shiller National Home Price Index is like owning the S&P 500. Okay, you own like one stock, you own one house. And it's obviously you're going to have to live somewhere, and you can obviously use that asset to help fund your retirement. But just be aware that that if we have another bad event, the value of your home could drop significantly. But if you've got equity, congratulations. The next question though is how are you going to harness that when you actually retire? Right? There's been research on reverse mortgages, things like that. Those still aren't very attractive for a lot of retirees. In my experience talking to advisors and retirees, people often view the home equity as kind of the asset of last resort that they'll harness if they need to fund retirement if things go poorly. But I don't know that that's going to be an option for a lot of folks in the future. So obviously, to your point, it's never a bad thing to have equity in a home. But at the same time, just be aware that home equity is actually a quite volatile asset. And we've seen a lot of that, especially over the last decade or so.
And I guess just kind of following that train of thought, is there anything else that people might be putting too much value on as they're looking at their current economic situation, their current savings strategy or wealth accumulation strategy that you would just provide a word of caution on before you kind of sail off and say, yep, I'm in great shape, continue down the current course?
Well, I mean, like the one thing that I talk about a lot today is are reasonable returns and reasonable expectations for the future.
Yeah,
and
good point.
I think that too often a lot of online calculators, especially, and even advisors use historical long-term averages. Like my favorite story here is I will leave the company name anonymous, but they have a tool that does 100,000 Monte Carlo simulations. And if you're a nerd like me, you're like, wow, that's a lot of simulations for a Monte Carlo run, But they use entirely historical long-term averages. And to be totally honest, I'd rather have a 100 return paths that use forecasted returns than 100,000 that use historical averages. And I worry, that for folks who are at or near retirement, you want to make sure that your retirement strategy is based upon reasonable returns. Now, I have no idea where bond yields are going to be 10 or 15 years from now. But I am very certain if you go out today and you buy a bond, a government bond, you're going to earn 50 basis points ish for the next 10 years. Right, that's relatively certain. And so like the implications of the lower yields right now isn't that big of a deal if you're 25 years old. You might have lower returns for the next decade, but who knows where it's going to be when you retire at age 65. I think it's really, really important for folks who are at retirement to understand what low returns mean and how it affects your strategy. Do you delay claiming Social Security? Can you actually afford to retire? I think it's just kind of, again, no one can predict the future when it comes to returns, but you've got to be reasonable in terms of what am I assuming my portfolio is going to do, especially in the near future.
And I guess on that note, we've come off an amazing decade. Obviously, it started with a pretty big crash back in 2007, 2008. But since then, we've been in a really good spot. As we look here in the 2020s, are you guys offering any kind of return forecasts or return projections? Or if somebody sat down with you with over a glass of your favorite alcoholic spirit and just said, hey David, tell me what you really think might happen over the next 5 to 10 years, what is that, either from Morningstar or just in your own opinion, what does that look like?
So as a Kentucky native, my favorite spirit is obviously bourbon. I had to throw that out there.
There you go. Absolutely.
But it's depressing, right? I mean, if government bond yields are under 1%, you're going to earn 1% on bonds. And, if you assume a positive equity risk premium, which I think is going to exist, the realized return of equities over bonds is about 3% historically. So what does that mean? It means 1% ish on bonds and 4% ish on equities. Then you tack on some inflation and some fees and some taxes, and it's very depressing. Right. It's not good for anyone. I think the larger question is this the new normal? Bond yields have kind of gone back to that long-term average of about 5% ish over the last 150 years. Over the last 800 years, if we want to go back that far, we actually are where we're supposed to be. So I think for me, if I'm being totally honest, I don't see things changing that much where they are from today 20 or 30 years from now, right? And I hope I'm wrong. I'm wrong a lot, but and why that's just so important is let's just assume that this is the new reality. Low returns for a long time. That has tremendous implications for how much you have to save for retirement, right? If you reduce return assumptions by 3 or 4% over a 10 or 20 or 30 year time horizon, all of a sudden 20% is the new 10% when it comes to required savings rates. And so obviously I don't know what's going to happen. I think with all this, it's so important to kind of go in regularly and revisit your strategy and make sure whatever you're using for your assumptions are reasonable. Because if not, if you fire and forget, you come back in 10 years, you could be in a very rough spot.
So on that note, what does that mean employers should be thinking about as it relates to their investment lineups? Because one thing that I noticed in a lot of lineups is there's a tremendous focus on U.S. equity. There's a tremendous focus on high quality bonds. And once you get outside of those two, it's generally pretty sparse in your typical 401k lineup.
Yeah, so it's funny, there was early research that came out over a decade ago talking about how larger lineups reduce plan participation. okay, that is like irrelevant today, okay, because right now people get automatically enrolled. And I was looking at a fourth review with like 60 options. Like 401ks don't have 60 options. They have like 18 on average. And so from my perspective, 80%-ish of new participants on average end up in a professionally managed solution. So a TDF, a balanced fund or managed accounts. If you have a core menu, which every plan should, it should be pretty robust in my opinion. Like I'm a lot less worried about, John Doe throwing all of his money in emerging markets today than I was say 20 years ago. So I think it's just, when you're thinking about the core menu, you need to realize that the role of the core menu has changed dramatically over the last 10 years. 10 years ago, the core menu was the menu. There wasn't a default investment. Everyone built portfolios themselves. Today, that's increasingly rare. And I think you want to make sure to give participants access to a good menu of funds because you want them to stay in the plan. Again, like I think that 401ks are a phenomenal way for someone to kind of build wealth and maintain wealth. And so don't nudge someone into a brokerage window to get access to a tips fund. Offer one as part of the core menu.
No, well said. And I do think that's something that I think a lot of plan sponsors are going to have to get outside their comfort zone in the coming years, where I think a lot of people have done extremely well just kind of playing it very traditional, very narrow in what they've been offering in the plan. But there's a lot of other people I've had on the podcast. There's a lot of other conversations I've had where, despite what we're seeing in kind of the current markets, a lot of people are saying, "Hey, this is great. Enjoy it while you can." But it might not be today. It might not be tomorrow. But the future or the next 5 to 10 years, maybe as you were saying, the next 20 or 30 years could look very different. And that, this kind of S&P 500 focused, this Barclays average focused investment lineup probably needs to be rethunk.
Yeah. I mean, I'm a fan of I think I forget, it was be broad but not deep. Mm-hmm. You don't need 8 large cap funds in a menu. Yeah. You need to offer maybe large growth, large value, maybe offer an index fund too. But I really like the idea of offering international small cap, offering emerging markets, offering a really high funds. But you can have a really, really diversified menu with 25 funds, or you can have a menu that's got 8 large cap funds and 4 ag funds and not have made a lot of progress. So I think the key is being very intentional with what you include in your lineup versus just kind of adding funds because you like the manager, you like the performance, things like that.
You've been incredibly generous with your time, as always, sharing some great input. Let me give you a chance to wrap it up here because I know we did cover a ton of ground. So someone has hung with us on this conversation and is really interested to hear, okay, David, I'm a plan sponsor. I'm an employer. I really want to, put some ideas out there to my retirement committee. I really want to think progressively about how better to help my employees and help them get to better outcomes. Here's my top 2. Here's my top 3 ideas that I would share with you.
Yeah, I mean, I would, my number one, I think it gets back to this idea of human capital. It's just thinking of your participants' wealth holistically, right? Human capital is an asset. The 401k is an asset. You want to make sure that participants are utilizing all their assets as effectively as they can, right? And that obviously, plan sponsors approach things like wellness and retirement benefits differently, but understand that it's all connected. And that, that the more efficiently that they make choices across domains, the better off they're going to be.
Awesome. I appreciate your time. As always, would love to have the opportunity to have you back down the road and keep up the good work. And I guess remind me where people can find you if they like what they heard today. Where's the best place to follow you, find you, kind of keep up with some of the stuff you're putting out into the world?
It's not very good. I would say I would recommend LinkedIn is probably the best option. I've got a website, davidmblanchett.com. It's not very good. It has some research, but those would be probably the 2 best places.
Awesome. Well, thanks again. As always, appreciate it. And all the best in the rest of 2021.
Great. See you, Rick.
And there you have it. David Blanchett, head of retirement research for Morningstar's investment management group. Great concepts on total economic worth and, quite frankly, a lot more. As a reminder, if you did like what you heard from David, check him out on LinkedIn. Great stuff he puts out there, as well as go to his website, davidmblanchett.com. Coming up next on the podcast, we are going to be diving into the new state-run plans. We have some news and statistics from the new California state plan, as well as we're going to have an East Coast plan join us and talk about their different strategy that they're going to be bringing to the state plan marketplace. All of that kind of bundled together in one action-packed episodes. Also, if you have an idea for a guest or a topic, always love to hear it. Best thing to do is to send me an email to info@401kfridays.com, and we'll take it from there. That's it. Until next time, I hope you make your Friday a 401k Friday. And now, for some disclosures. The content in this podcast is provided for educational and discussion purposes only. Investing involves risk, including a potential loss of investment. Lockton does not and cannot guarantee the future performance or specific level of performance, the success of any investment, or success of any strategy. Nothing contained herein may be construed as investment or legal advice.